We're jumping straight into Bitmine immersion technologies today. Everyone is watching the price action, but the real story is their strategic pivot away from self-mining and into high-moat ecosystem services and treasury management.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Subscribe and hit the like button so you never miss out on simplifying the market's biggest moves. And let's just set the stage for you right off the bat here, because the context today is, well, it's pretty crucial.
Yeah, it really is. I mean, today is March 9, 2026. If you've been anywhere near the crypto markets lately, you know we're seeing some truly intense momentum.
Oh, absolutely massive. Bitcoin recently reclaimed that huge psychological barrier of $70,000. We even saw it peak over 72,000 around, what, March 4th?
Yeah, right around the 4th. The energy is totally palpable out there. But, I think a lot of people are actually playing it the wrong way.
Right, they usually do.
Exactly. When you see that kind of price action, the natural instinct for, well, most retail investors is to just blindly chase the coins. They see the green candles and they want in on Bitcoin or Ethereum directly.
Yeah, just hitting the buy button on the exchange?
Yep. But looking at infrastructure players, specifically Bitmine Immersion technologies, that gives you a totally different, a much more calculated way to play the sector's volatility.
Which is exactly why we wanted to bring them up today. It's the classic picks and shovels play.
100%.
During a gold rush, you don't necessarily have to be the one mining the gold. You sell the equipment and the services to the guys doing the digging.
Right, to sell the shovels.
So let's get into the bull case here. The fundamental shift, the thing that really caught our eye, is this deliberate operational pivot they're making.
Yeah, they are actively winding down their high-cost proprietary self-mining operations.
Which, on the surface, moving away from mining during a massive crypto bull run, that seems entirely counterintuitive. Why walk away from your core business?
I get why it looks that way, but self-mining is it's a brutal, highly capital-intensive arms race. Think about what it actually takes to run a competitive mining operation today.
A lot of hardware.
Constant hardware upgrades just to keep pace with the network hash rate. Plus, you have these immense energy expenditures, and worst of all, you are entirely at the mercy of the underlying commodity's price.
Right. If Bitcoin drops 30%, your margins basically evaporate overnight.
Exactly, but your electricity bill stays the exact same. So what Bitmine Immersion Technologies is doing instead is, honestly, a strategic masterstroke, assuming they execute it right.
Which is a big assumption, but yeah, what are they shifting to?
They are focusing heavily on Ethereum treasury operations and Bitcoin ecosystem services. So we're talking about consulting, advisory roles, equipment leasing, stuff like that.
Okay, so they're stepping out of the trenches and basically becoming the quartermaster for the rest of the industry.
That's a great way to put it.
But let's break down the physical reality of what they actually do. I keep seeing this term immersion cooling attached to their name. I know it sounds super high-tech, but what does that look like on the ground? How is it different from a standard server farm?
Oh, the physical difference is night and day. Have you ever walked into a legacy mining facility?
It's loud.
It is deafening. They use these gigantic air conditioning systems, high-velocity fans, just to keep the machines from physically melting down. It's wildly inefficient.
Because they're just blowing cold air around.
Right. A huge percentage of the electricity they buy isn't even doing any computing. It's literally just moving air. Immersion cooling completely changes the physics of the operation. You are actually submerging the hardware in specialized liquid.
Just dropping the servers right into liquid.
Literally into tanks of liquid. It's non-conductive, obviously, and fluid transfers heat way more efficiently than air does.
That makes sense.
So this lets them have much higher computational density. You can pack the machines way closer together, and it virtually eliminates all that power waste from traditional cooling fans.
And that leads right into their namesake advantage. Correct. By providing this third-party power and hosting optimization to other clients, they're essentially locking those clients in.
Precisely. They are building a massive moat based on switching costs.
It's like trying to change your entire company's operating system the week before tax season.
Yeah, the friction is insane. Once a client relies on Bitmine's specialized liquid cooling infrastructure and they're using their specific power arrangements and advisory services, the sheer logistical pain of unplugging is what keeps them there.
Ripping all that wet hardware out to go back to a traditional air-cooled competitor.
Or even just a different immersion provider, it's an expensive nightmare.
So it's incredibly sticky revenue. Let's contrast this with the rest of the industry, though. When you look at pure miners companies like Marathon, for example, they're playing a totally different game, aren't they?
Oh, yeah. Pure miners have this looming structural threat built right into their code.
A halving cycle.
The halving cycles. It is the defining variable for pure miners. Every 4 years, the network protocol dictates that the block reward gets slashed in half.
So a pure miner wakes up one day, and their primary revenue source is literally cut by 50%.
Exactly, 50% gone. While their operational costs and facility leases stay exactly the same, it creates this punishing boom and bust cycle.
So by shifting to this service-based model selling equipment to related parties, leasing out optimized infrastructure Bitmine immersion technologies is drastically reducing its exposure to those severe cycles.
Which paves the way for potential margin expansion. They are insulating themselves from the worst of the cycle.
And we're seeing the market react to this, right? Look at the recent price action. On March 4th, the stock traded significantly higher in tandem with the broader crypto rally.
Yeah, indicating really strong trader interest and positive momentum flow.
Right now, it's trading around $18.88, recently opened at $19.53. So it's showing some real psychological resilience above recent lows.
It is.
But I gotta play devil's advocate here, because if you pull up their metrics right now, you see a PE ratio of 0. I mean, 0 is 0. Isn't that a red flag?
Well, sure. For a traditional value investor, maybe. But you have to look at where they are in their corporate life cycle. They are in a pre-profit stage.
Which is pretty typical for growth-oriented crypto firms making a big pivot.
Exactly. Their focus right now is entirely on cash preservation and aggressively reinvesting the proceeds back into their treasuries and their services. That reinvestment is what supports the long-term growth thesis.
Okay, so that's the bull case. The sticky infrastructure, avoiding the halving cycle, reinvesting for growth. But looking at the flip side, we have to talk about the bear case. Because crypto definitely does not move in a straight line.
No, it never has. Just shortly after that massive surge around March 4th, we got a harsh reality check. Bitcoin and Ethereum dipped right back down to the $68,000 level between March 5th and 6th.
And when the apex assets drop, it drags the entire sector down with it. Crypto-related stocks included.
Exactly. You can have the best cooling tech in the world, but if the broader market takes a hit, you feel it.
And there's some specific stuff happening with Ethereum right now, too. If they're building an Ethereum treasury, we need to address the bearish news circulating in the market. People are throwing around the term death spiral.
Yeah, the Ethereum death spiral reports, those have definitely amplified downside fears.
What does that actually mean structurally? Because it sounds like financial media panic bait.
It sounds dramatic, but there are real mechanics behind it. A death spiral usually refers to a cascading liquidation event in decentralized finance. There's so much leverage built on top of Ethereum.
So if the price drops too far, it triggers automated sell-offs.
Exactly. Those forced sales drive the price lower, which triggers more liquidations. It feeds on itself. And if you are a company holding a massive Ethereum treasury, that means your balance sheet is actively deteriorating.
Which obviously puts a heavy weight on the perceived value of their treasury operations.
That's for sure.
And the headwinds aren't just coming from inside crypto. The broader macro and geopolitical environment is incredibly tense right now.
Very tense. Prominent voices like Tom Lee, for example, have pointed out the ongoing Iran-related volatility.
Right.
That adds a heavy geopolitical risk premium to the markets right now. When global tensions flare, institutional money tends to pull back from the furthest edges of the risk curve.
Crypto gets sold off when that risk premium spikes. It trades like a high beta tech asset.
Exactly.
Which brings us to the execution hurdles. We talked about their pre-profit status, they lack specific forward earnings guidance, and frankly, the balance sheet details from their latest SEC filings aren't fully transparent yet.
That's the vulnerability. The burden of proof is entirely on the company right now. They have to show that this pivot to services can consistently generate free cash flow compared to traditional mining.
It's a great story, but they need the hard numbers to back it up. So for the folks listening, what are the triggers to look out for? What's the roadmap for the next 30 days and heading into Q2 2026?
The single most critical event you need to watch is the Q1 2026 10Q earnings report. That's the big one.
Okay, the 10Q.
Investors need to monitor this closely to confirm that the crypto rebound is genuinely translating into service revenue. We need to see if the leasing and advisory fees are actually materializing.
And aside from earnings, keep an eye out for any upcoming sector conferences focusing on blockchain and treasury management.
Oh yeah, those often serve as major PR catalysts for infrastructure companies.
Now, what about macro stabilization signals? What should we be watching on the charts?
Watch for Bitcoin and Ethereum to stabilize past that recent $68,000 dip. If the floor holds there, it proves resilience.
And speaking of Ethereum stabilizing, I want to bring up a highly speculative but really fascinating catalyst. Tom Lee actually just came out with a call today, March 9th, calling an ether bottom.
Yeah, I saw that. It's a bold call.
Very bold, especially with those death spiral rumors still echoing. But if he is right, that could spark massive upside for Bitmine Immersion Technologies' Ethereum treasury.
Exactly. Even amidst the general skepticism, a confirmed bottom there validates their treasury management pivot overnight.
And looking at the broader picture, if the geopolitical risk premium resolves, if the tensions ease up, expect a potential crypto sector rotation going into Q2.
Money that's been sitting on the sidelines could flood right back into these infrastructure plays.
To bring this all together, Bitmine Immersion Technologies is fundamentally an infrastructure play. They are trading on the momentum of the crypto sector, but they're actively trying to insulate themselves from the worst of the volatility through these high-moat services.
They want the upside of the boom without the brutal downside of the pure mining crashes.
Exactly. So I want to leave you with a final thought to mull over today. Is shifting to the picks and shovels service model the ultimate way to survive the wild swings of the crypto market? Or are companies holding massive Ethereum treasuries ultimately just as exposed to the whims of the coin prices?
It's the multi-million-dollar question.
Thank you for tuning in to the Easy Money Show. We will catch you next time.